Welcome everyone. How we doing? Of course, Lambos is here. Everybody had a good day today. Rudy, how we doing? JJ, doing good, doing good. Just hanging. Had a not the best Monday, Tuesday this week in the market, but Wednesday and Thursday really kicked it up for me, that's for sure. Ready for a little bit of fun tomorrow. I like Fridays. I take them so unserious that it's always a good time. Thursday, though, Thursday is like no questions asked my favorite day to trade the market. Yeah, perfect, perfect. Yeah, this class is gonna be, it's gonna be open-ended. It's gonna kind of talk about, it's gonna talk a little bit about a lot of things. So, we'll have plenty of times for questions. We can talk about charts. We can do whatever for sure. Welcome everyone. Hope everybody's doing good. Hope we all had an awesome day. Man, hmm. I gotta be honest with you. I took a lot of trades today. I'm gonna be real with you. Let's see, what did we trade into close? I know we were hitting those 569s a lot. Um, of course, the only trade that I remember right now. Um, oh no, yeah, I remember too because I did them back to back. So today, and so something that and we'll just talk for a couple of minutes. Welcome everybody. Well, as people kind of pull in, I'll make another post here, but we'll talk for a second. So I'm going to talk about a couple trades that I took here, but I have to point out that what is going on this chart, the SPY chart, super helpful, of course. You have to look at the rest of the market is something that I think everybody always forgets. So we can talk about what I was looking at on this SPY chart. But if if we were being real, I'm also watching Apple, Amazon, Microsoft, Nvidia, XLF, and XLE. And so when I'm watching all of those, what I was seeing was some tech names setting lower highs, blah, blah, blah. We'll even pull up QQQ because, it can be, if you want to watch QQQ as well, it kind of helps you cover most of those tech names also. But so QQQ, 1 second. So QQQ and SPY. We're looking at them. We're just going to pretend this completely represents tech. See how similar these charts are today. So one trade that I took on SPY today was on this bounce back up. We actually caught this short too, but this one was sort of a bit of luck. But on this bounce back up, so SPY was pushing up. We had QQQ and we had QQQ over here starting to push up below the VWAP, below a level, below EMAs. So I took a short somewhere right around here. I don't know what it is, and ultimately got super blown out. The trade eventually paid, but that's dumb. That's a bad trade. I even called it a bad trade. But took this short because the market was telling me, hey, we are kind of bouncing, market's still weak, market's still setting lower highs, QQQ's below VWAP, below level, blah, blah, blah. Well, it exploded. So then we got stopped out. Well, I'm good at just taking the stop out or whatever, ignoring the trade. Next thing I started watching for was this. So I love a three push wedge. So we still had some of those tech names setting higher lows. We actually had tech starting to roll over. We had XLE starting to roll over. Big pops on VIX. As we were kind of going up, we were starting to see VIX go up. So that was another one. I again, look up here, and this will we're actually going to talk a little bit about this trade. I get up here. Everybody wants to hammer calls. I don't. I start to analyze the risk reward. I start to look at the market. I say, I have a three push wedge. Maybe you trade these, maybe you don't. Doesn't matter. I start looking up here. I start seeing these wicks happening, wicking down. I see a big level over here. I see resistance over here. We see obviously tech starting to falter sooner than other, faltering before SPY is faltering. Yeah, I am sharing my screen. I hope. So then I took the short up here again, simply targeting down to here. I was looking for that move back down towards VWAP. So it was a trade that got blown out, stuck with the thesis. Look at this, I say to myself, am I going to buy calls 20 cents below not only 570, but 570.15 and right at this level? Absolutely not. Risk reward tells you short this. Maybe you get blown out, maybe you don't, but it was one that didn't work and then ultimately worked for us. Okay, welcome everybody. Give me one more second. I don't remember what other trades I took today. I traded T. I didn't trade any of this morning, really. This was my recommended bounce point on SPY. A few people caught that. I unfortunately didn't, but I swung some T calls and those worked. So I stuck with that trade for a little bit. 1 second. Yep. And if you're ever, in voice chat or anything, I always forget to share my screen. Tell me to turn my screen on. I'll show you exactly what I'm looking at then, Okay, one more second. Okay, welcome everybody. How we doing? Happy to have you here, Dirty River. So we were just doing a little talking before class, nothing specifically about this. But tonight is going to be a little bit of an interesting class. We're going to talk about a bunch of different things. We're going to talk about just some ideas that I use, things that I believe in, just try to talk about some reality type of stuff, I don't want to say goals. I typically think goals are a really bad idea, but how can we, actually trade in this market and not treat it like a gamble? We see a lot of it, especially lately. I don't know what's gone on over the last 4 or 5 months, but man, people are just, they want the lottos. They want to wait all day, like even for me in voice chat, we have a lot of serious trading going. I mean, whatever serious doesn't matter, but we talk less in the pro voice chat, a little bit more focused on trading. If we are talking, it's generally about something trading. But Friday rolls around, there's people that I haven't seen all week in pro, saying, oh, what's the trade? Like, where's the move? Because they want the lotto. And lottos are great, there's a time and a place for them. They're definitely high risk, potentially high reward. I think most people kind of go about trading them incorrectly. We're going to get into that with position sizing tonight, obviously. But we're going to talk about a lot. We're going to talk about position sizing. We're going to talk about analyzing risk reward on charts. And how can we use that to protect the money that we've already made? We see it all the time. Somebody's, they're having a great day. They're super loud in the morning, and then, they go quiet. And end of day rolls around and they're like, oh, dang it, man. I gave back all of my gains. We see it all the time. It's like SPX, it's like the Grim Reaper for your port. At the end of the day, it either makes you really happy or really, really sad. And so tonight we're going to try to talk about how to not land yourself in that situation. And then, of course, when you're analyzing risk reward, it's always going to be on a chart. You guys know, you've heard me say it a million times. If I'm teaching something, I am always going to try to apply it to the chart in one way or another, because the charts are what we trade. There are, of course, fundamental only traders out there. They're generally speaking having a slightly harder time. They always say don't try to time the market, time in the market, which is true. But if you try to time the market at least a little bit, you can kind of find yourself in a better position. And so there will, if you're trying to be a day trader, scalper, day trader, whatever it is, you need charts. Charts tell you when you're right, tell you when you're wrong. So even though we're talking about position sizing tonight, it still comes back to the chart. And so I'm always going to try to relate everything to that, because it's what we all look at day to day, or at least I hope a lot of us are looking at it. If you aren't trading, if you're just taking alerts, I get it, but I recommend, say I alert something. One of the best ways, at least for me, to learn, it's how I've even picked up on things from, people like Tilio, stuff like that. One of the best ways for me to learn is to see it on the chart. Somebody can tell you, oh, short a bounce to VWAP. Well, if you aren't looking at a chart, you can't really understand what do they mean short the bounce to VWAP. They like, so just as a random example. And so that's how we're going to use it tonight. We're going to use our charts to, we aren't necessarily going to be talking about trades that we took or we didn't take or we wished we took. We're going to talk about what does the chart tell us as far as how we should position. And how much risk do we have on the trade? How much potential reward do we have on the trade? And so it's going to be, a lot more talking tonight, less technical on the charts than normal. But hopefully, I think, a lot of people struggle with this. It's of course going to have, hints of trading psychology tonight, of course. But I want all of you to ask questions as I'm talking about it. We're going to talk a little bit about, different port sizes and ways that you can deal with your position sizing in relation to those. And so with that, again, thank you for being here, Dirty River. Let's get started. So we're going to start with position sizing. And how should you position size? And, where, depending on the size of your port, how should you be positioning yourself to try to protect your money? But what I always try to teach people is to make as much as possible with as little as possible. Something that came up in voice chat today, that I was actually getting asked about position sizing and risk reward in voice chat today, just by chance doing this class tonight. And uh, what I told him is, you never go heavy. There's never a reason to go heavy. There's never any time you should be heavy in a trade. There's 1,000 available trades a day. Never put your eggs in the one basket of a trade. I don't care who you are. You never go heavy. If Tilio messaged me and told me I went heavy in this, I'd tell him, well, that was dumb. I don't care who you are. I don't care if you're an analyst. I don't care if a member. If you say that you went heavy in a trade, then you have work on your trading psychology that you need to do. I don't care who you are. This applies to anybody who trades. If you go heavy, it will eventually come back and bite you without a question. And so, what are some reasonable position sizes? What are some, things that we like? What is it? What is a size that we can try to trade? Because people love to throw out 10% of your port. I think that's entirely too much, generally speaking, because you have to be ready for, because I know a lot of people don't trade with hard stops, and myself included. I have, when I trade, and I guess I'll just talk about this. So, and I'm picking some completely random on the chart. I don't know if I took this trade. It's hindsight trading. None of that matters. We're more discussing an idea right here. So if I take a trade, say I see the market pull down and now I see it bounce back up, and I'm looking for the market to set a double bottom. So we set one right here. So I take this trade. Well, when I think of a stop loss, I always think of it in two ways. There's two stop losses that should be on any chart. So I might take this entry right here, and I'm going to say to myself, my stop is a break and close of the bottom of this candle because it shows the double bottom's not holding. Maybe the market's resuming trend down. So if we get a candle close right down here, that's my planned stop. That's it. Like that's the planned stop. So you can say, and we'll talk a little bit more about risk reward here in a second. You can look at this and you can basically say, if we close down here, I'm taking the stop out. So I got about 30 cents of risk on this trade. Well, I also have another stop in mind, and it's going to be down here. And it's the stop that nobody thinks about. And we've seen in this market recently how bad it can go for you if you don't have something like this. And I call it a protective stop. And what the protective stop is where you get out. It doesn't matter. You are wrong. You are 100% wrong on the trade. I talk about it all the time. Maybe you have a trade. I had one today. And it's a bad trade. And it ended up running 600%. It's a bad trade. Because I didn't hold for 600%, don't worry. But it's a bad trade. I let it go minus 50%. If you let a trade go minus 50% and it comes back for you and it goes green, I'm happy for you. And it was a horrible trade. There's no way around it. So, because if you lose, that's the thing nobody talks about. Oh, oh yeah, I'm going to hold this trade. I don't care. I have time or whatever it is. Well, it's when you take the stop out. If you take an 80% loss and you're normally taking 20, 25% gains, well, your 80% loss has now just turned into 4 trades just to get back to where you started. Never land yourself in that position. So that's why I run something called a protective stop. It is my worst case scenario. Maybe we get a tweet. Maybe you're long AppLovin today and the short report comes out and they clobber it 15% or whatever it is on you. You need to not expect this, but be prepared for this. And so that's what I do. Any trade I take, protective stop, no questions asked. And if that hits, I am out of the trade. I think it's an extremely important thing that people need to do more often. One of the main things I see people struggle with, and a lot of this comes to position sizing, not analyzing risk reward, is clicking the sell button when you're red. Because admitting that you're wrong is very, very hard for traders. And so how can we work with that? And how can we analyze this before we take any trade to know if how much money can I make? Oh, I just realized, let's see. I'm going to do this. I have to change how I'm streaming. I apologize if this messes it up. Let's see what happens. Everybody still here? No issues? Answer me there. Okay, we're looking good. Let me make sure, yep, I'm on the right account. So we want to, thank you, everybody. So you always want to analyze risk reward before you enter any trade. And so how, people always ask me, well, how do you do that? What do you look at? How do you analyze risk reward before you take a trade? And so this lecture tonight, obviously it's not a Greeks lecture. So we aren't going to dive into the Greeks a whole lot. But how I analyze risk reward is I look at the option chain. And so what I've pulled up right here is the option chain. I don't know if people are on Thinkorswim or whatever it is, but this is the option chain on Thinkorswim. It tells you, the value of your SPY contracts, the value of your SPX contracts, whatever it might be, and how much money you stand to make or lose. So for tonight, and this is just going to be one example. We're going to get into a few more. I'm just going to pull this up. I'm going to have it sitting right here. And we are again going to use this, made up trade that, maybe you took, maybe you didn't. It doesn't matter. So how do I start to analyze risk reward? I do it in the option chain. That's where it starts. And this is something that I wish more and more people would do. So I'm analyzing risk reward here, and I'm looking at, this SPY chart, and we're trying to buy the dip right here at 566.40. And I'm going to bump this up. We're going to bump up our protective stop to, just below 566 for explanation's sake, nothing, more than that. So here's our option chain. We know delta. That's this first column that I have right here. You've probably heard people talk about it. It's a Greek, it's an option Greek. It tells you if the stock goes up $1, how much money will you make? If the stock goes down $1, how much money will you lose? So that's where your risk reward analysis starts. So if we're going to buy calls here, and I'm just going to use these, the strikes that, and I'm going for the next day contracts. If we want to buy calls right here, and they're going to cost us 260 bucks, and we know that we're going to stop out if we get a 30-cent drop. And we're just rounding this, that's a pretty tight stop for today's market. So, this isn't necessarily teaching, this is explaining how to analyze, or, teaching how to trade. This is teaching how to analyze risk reward. So we go to our delta column, and delta tells us we'll make or lose $49 for every $1 that SPY goes up or down. Well, we know we'll call it 33 cents just to make it easy. We got 33 cents of risk on there. So you take 49 and you figure out what is 33% of that. And it's, I don't know, I'm doing the math in my head, 17 bucks. So you have $17 of risk. That's how much you're risking on this contract. You don't always have to, figure out that exact number, but now you know your risk. So now you look for the reward side. And this is all part of planning your trade. You can't just throw out random numbers. You can't be not trimming. But let's say you're buying this double bottom, and our trade plan is we are looking for a move back to VWAP. And that's, we're just making up a random trade plan. So we know we have 30 cents of risk on the trade or whatever it is. We're risking from, 566.33 down to just under 566. Well, we're looking for a move from 566.33 up to 568.11, and that's probably too high. We're going to tone that down just so people don't get crazy. We're looking for the move to 567.78. So we're looking for about $1.30 move. So again, we go to our risk reward here. We're making 49 bucks for every $1 that thing moves. Now we're looking for $1.30 movement. So we know our potential maximum reward for our trade plan is 67 bucks or 60. I don't know. I'm doing the math in my head. I apologize if it's wrong. 65 bucks. So we're risking 17, because that's where our stop would be, to potentially make $65. That's a great trade, awesome risk reward. Plenty of plans. We know how much we're risking, and we know how much we have the potential to make. Of course, if you start seeing nice green, you should be trimming, blah, blah, blah. That's not what this lecture is about. It's merely analyzing risk reward. So this is a trade that, would have worked in your favor. You knew ahead of time about how much you're going to risk. Because these numbers are always moving, give it plus or minus a few bucks, but we know we're risking, give or take 16 bucks to make, I don't know, 65 bucks or whatever it is, 60 bucks. So nice risk reward there. One risk, three reward. It's a trade that is definitely worth taking. So really, really nice risk reward there. Now we're going to talk about a trade and a trade that I would never take, but a trade that a lot of people might actually go looking for and think is a trade worth taking. So, and again, we're using my levels, we're using my indicators. Maybe yours are a little different. I want to just emphasize this isn't about the technicals on the chart. It's about analyzing our risk reward here. So say we see this breakout, we see the break above VWAP, we see the break above these highs, and we start looking up here and seeing a breakout, and we say to ourselves, well, I think we're going to keep going. So I'm going to get long. Again, this is not a bad trade, and this is not a good trade. And our risk reward is going to help us understand that. Well, if we're looking to play this breakout, we think it's going to keep going to the upside. We can only make decisions based on what we have on the chart. So maybe, you think, or your hope is that we're going to get this breakout, we're going to break this level, and we're going to go up here to these highs. Well, fine. I think that you're buying calls at resistance. We're ignoring it's 570, 570, 15, big level, you know. But we're going to buy these calls at resistance for whatever reason. Well, we come here and we analyze our risk reward. We know that we're looking to long 570. I know this is dumb. Just ignore the numbers. We're looking to long 570 with hopefully getting a move up here to 570, 80 at the most. So we got about 80 cents of upside. So again, we go to our delta and we figure out what 80% of 49 is. I don't know, it's like 40 bucks. So potential to make $40 if we catch the move up to these highs of days. Well, now we have to analyze, where does our stop go? Well, our stop is really going to be a break under this high right here, give or take, you know, somewhere under there. Because we know that if the market's going back under this previous high, it's likely reversing. So we know that our stop is down here. Well, we're getting long at 570, and this is 80 cents below 570. So now all of a sudden we're risking $40 to make $40. It's a one-to-one risk reward trade. There's times and places where these can make sense, specifically scalps. We're going to get into that here in a second. But generally speaking, they are not good trades. You need to be right a lot of the time. You need to be right over, you need to be right most of the time to be making money on one-to-one risk reward trades. Because every single time you go, every one trade you lose, now you have to do one trade just to make it back to be break even. So you aren't making money. So really, for every one trade you lose, you need two trades to find yourself making money. Whereas this one down here, one risk, three reward, because we were risking whatever it was, 20 bucks to make 60 bucks. Well, if you catch this kind of trade and say you make 60 bucks, well, if you take another one of those, and we're going to get into this in a little more detail in a second, if you take another one of those and you stop out, you're still up 40 bucks because you only risked $20 to make your first 60. Well, now you stopped out. You only risked 20 bucks. So you still got 40 in your favor. So when you get those better risk reward trades, and you don't just want to say, well, I'm buying calls down here, I'm going to stop under 566 and I'm looking for a $3 move back to the upside. That's not how you do this. You base everything on your chart, look for previous highs, EMAs, VWAP, whatever, but always, always, always analyze the risk reward before taking any trade. So does everybody get that? It's simple, and actually I want to include one more thing. And I like it. I like looking at option Greeks. I understand some people don't. If you want to do this easily and not think about so much the specifics of what your contracts will make or lose, you can do it just on the chart. Say to yourself, I'm risking 30 cents a downside to make a $1.30 upside, or whatever it is, a buck upside. So you can just say in your head real quick, one risk, three reward. I'm risking, 30 cents to make 90 cents or whatever it is, 120 cents. Do it just quick in your head. You don't necessarily need to dive into the Greek, know the exact amount you're risking, but you need to make sure that, the ratio is in your favor. As I said, to kind of start this lecture, our goal as traders, and why you should never be heavy and all of that, is make as much as we can with as little as we can, and look for these high probability trades. Nice little double bottom here. We know we got a nice upside potential move. We know our stop is relatively tight. Whereas this one, you're chasing a move to the upside. You're buying calls at a double top. Let the chart tell you this isn't a good trade. And let the market work, and it will work much better for you. So does everybody get that? Any questions? We got a nice little crowd in here. Thank you everybody for being here. Does everybody get how I do that? It's simple. So I'm hoping that we all get it, and apply it to your trading. Okay. No answer is a good answer, I guess. Give me 1 second, take a drink of water. So that's how we analyze risk reward. The next thing we're going to do, is now we're going to discuss position sizing. And I think this is where everybody messes up in a gigantic way. It's a very difficult thing to talk about. And so, because proper position sizing is subjected to the type of trade, size of portfolio, all of that. If you got $100,000 port and you're putting 10% in every trade, you're insane. You have no business doing that. You would be laughed at by real traders. You know, that is appallingly over leveraged. Well, maybe you're trading with a $500 port, and a lot of people in here are. Um, it can be more difficult to find a safe contract, you know, one that actually makes sense that fits your price range. You know, if you have a $500 port, there's a very good chance that you are going to have 10% or more of your portfolio in a trade. That's just the market that we work in, especially with the things that we like your people like to trade. You know, you got people like me and 1K and stuff that we try to push your AT&Ts, your Coca-Colas, your Walmarts, you know, some of those cheaper names. There is plenty of names out there with contracts that are 30, 40, $50 that are very reasonable, you know, and they're a good strike, all of that. You know, if you have a $500 port, just to bring these back up, you have no business trading, and these are next days, but you have no business trading a $260 contract because that's half of your portfolio. So what I try to teach people as far as position sizing is one of the greatest skills that you can build as a trader is saying, this trade is not for me. You know, and that's it. You know, if you can say that to yourself, you know, maybe, you know, somebody alerts a $700 Tesla contract and you got a $1,200 port. Well, sure, Tesla can move and it can pay huge, but you can't put that much in your port or into one trade, that much of your port into one trade because it's just too much risk. So what I like to tell people, and again, like I said, if you have a very smart, not very small, but you know, a smaller portfolio, you're 500, 600, $700, you might get a little over leveraged. What I like to tell people is for really any scalp or day trade, you want to be around 5%. Even less if you can, you know, and that might mean one contract. People don't ever think about compounding gains. They don't, you know, you hear all of us preach it, me, 1K, Mo, everybody. Uh, you know, those small gains, they add up. That's what real traders are looking for. If you're out there hunting home runs, you're not going to have a good time, unfortunately. You know, you're going to find yourself deep red, all the time, trying to chase back gains, losing, you know, losing more than you're making. And it all comes down to position sizing. So size down, always size down. 5%, great place to be. Even on a bigger portfolio, you know, you got your $5, $10,000 portfolio, trade $250 positions, trade $500 positions, whatever it is, you know, but smaller positions and manage the positions better is going to be the best thing you can do. Again, I know it's hard with a smaller portfolio, but people dramatically underestimate what small gains can do. You know, 1% a day in about 4 weeks, 5 weeks, your portfolio is going to be close to doubled, you know, and that's just if you got $500, $5 that first day, you know, and then $10, and then it's $20, you know, and that little bit just adds up and adds up and adds up. And so, what I always teach people is any scalper day trade, 5% of your portfolio. And you have to understand that you need to be protecting those gains. Um, uh, you might have, you know, uh, sorry, I just saw something. I was in a single person plan at 1% a day. Yeah, forever. It's hard, you know, and it all depends on size of portfolio. That's the thing. If you have a very big port, 1% a day is tough. If somebody's telling you 3% a day, I mean, I'll look it up. We'll do some, let me try to find something um just to share it. Um so let's see. I'm looking for something. Give me just 1 second. Okay. Can everybody see this? This is going to be a really, really awesome example. This is going to be a really awesome example. So $1,000 port. Does everybody see this? I hope so. God, Mike, you're so funny. I wonder if it's really Mike. So 1,000% a day or $1,000 portfolio, 1% a day. And then so in the trading day, there's yeah, we'll just go this way. Include all days of the week. No. So $1,000 portfolio, 1% a day. This is your return at the end of the year. You do over 1,000% on your portfolio doing 1% a day. Something that I like to point out, there's a lot of those like, gurus out there. They try to say, oh, I do, 3% a day, shoot for 3% a day. If you have $1,000 portfolio and you shoot for 3% a day, you're making $2.2 million. It will not happen as your portfolio grows, of course. So be realistic. And if somebody is telling you they put up 3% days every day, then they're the best trader on the planet and they're making millions of dollars a year, and listen to them, but they are probably lying. So keep your gain goals realistic, and 1% a day is very, very doable. It doesn't matter, size of port, anything like that. And it's just a place where you can be, if you have less money, or a smaller port, it can be a really great, uh, uh, goal for you to have. I don't want to say goal because you don't want to shoot for those goals, but it's a very reasonable thing to do throughout the whole year with a smaller portfolio. Maybe some days you'll have a smaller percent day, 0.2. Maybe you'll have a bigger percent day, maybe you do a 2% day, maybe you do a 3% day. But what people don't ever realize is they don't like to do the actual math of how little you need to make each day. They go looking for those home runs. And so what I always try to tell people is if you're doing, 5% of your port in a trade, something like that. And say you got a $500 portfolio or whatever, and you got 25 bucks in the trade. If you take two of those and you're able to make yourself your 10% on each of those trades, then you've done 1% on your portfolio. 5% of your port, two different trades, 10%. You're up 1% on the day. You can be perfectly happy with that. Don't get sucked into the people in the gains tab that are like, oh, look, my $600 portfolio is up 3,000% this week, because those people are giving it all back the following week. Just really think about those compounding gains. Yeah, quit looking at gains tab. I call it the plague, dude. There's a reason that, you guys have never heard me tell people to post in gains tab or anything like that, because it's bad for mental, it's bad for everything. Stay out of there. And position size according to your portfolio. If your portfolio is bigger, size it down. Maybe you only put 2.5%. And that's great. Maybe you only put 2.5% of your port in there, and that's awesome. Take those reasonable gains and then uh, you know, slowly grow your portfolio. Don't be the person that's got the $10,000 portfolio, dumps it to $1,000, gets it back to $10,000. You don't want to be that person, Not only is it stressful, but it's just not a way you can continue being successful in the market. I'm sure a lot of you in here have traded with me in voice chat. You guys see, if I'm in 4 or 5 contracts and I see 10%, 15%, if I'm buying calls here, I'm trimming. If we're coming into any of these previous resistances, I'm trimming. And then I end up in one, and maybe that one runs a little bit, or maybe it stops me out at break even, but I collect my little bit of gains on the way up, and then I'm done. Then I don't have to care about what the trade is. And so it's one of the biggest things with position sizing is that you see what other people are doing. We've all heard that people, oh, you can't make money unless you have a lot of money in the portfolio. Well, no, if you, one, don't know what you're doing, two, refuse to learn, or three, have unrealistic ideas of what you can do. If you have a $500 portfolio, you aren't making $1 million this year. I'm here to tell you right now, if you got a $500 portfolio, you can for sure make $100 a month. You can do these little gains. You got a $500 portfolio, go make yourself $10 a day and you've made 200 bucks extra on the month. And, if you just keep that in your portfolio, making yourself 10 bucks a day, you'll make $2,500 on the year. I know it's not a ton, but it is a 500% return on your portfolio in a year. Never being over leveraged, never doing any of that stuff, really actually trading. And so that's what I encourage people to do all the time. Do we hit some big percents in the voice chat with me? Sure. But it's like I tell everybody, any of these 500, 600, 700% trades, I don't care who you are, there is a piece of luck in there. And I'll say the same for my trades. I'll do everything I can to make the trade. I can use all of the knowledge that I have to hopefully make the trade as safe as possible. But if you're getting a 500%, 600% return, you had a little bit of luck on your side. There's no way around it. But that's not what I go looking for. I track all my trades for voice chat and everything. I would say 75% of our trades pay 20%, maybe a little bit more. Those are the types of trades I like looking for. Give me my 1, 2, 3 candles, my 10, 20, 30%, and I'm happy with that trade. Maybe it runs, maybe it dies, maybe I feel FOMO, I don't, whatever. But none of it matters once you have booked a little bit of your profit. And so, again, position sizing is tough because it's different for every size portfolio. It really plays into your trading psychology. The people looking for fast money in the market oftentimes just lose money the fastest. And so stay realistic. Like I said, 5% of your port, 10% trade 2 of them. That's all you need. You're up 1% on the day. And if you can do something like that consistently, find yourself to get your nice some. I've done a bunch of it. I've taught how I trade. I've taught how to build trade plans around it. I've taught how to build trading strategies where, you look for X, Y, and Z to line up, and that is your trade. You like it. You can sit and wait all day for one of those trades. Or maybe you get lucky. Maybe the 5% of your port pays you 20% and you're up 1% on the day. You can feel free to call right there. So now, hopefully everybody gets that. Send questions if you don't. Now we're going to get into position sizing to protect your money throughout the day, throughout the week, throughout the month. So does everybody kind of get what I'm saying about, small positions, smaller gains, they add up. Sometimes you catch a runner, sometimes you don't. But look for consistency. Don't look for home runs. Does everybody get that? So the next thing, and I've talked about this, in quite a few of my lectures, and I'll send this over to anybody who wants it. This is just a little thing that I have written up on position sizing. So this is obviously and so this one you can see I wrote right up here, $2,000 port. It covers basically all of the same stuff that I just said, 5% of your port in a trade. And that's all you need to make a little bit of money, And so now I go into, this is where we kind of wrap the position sizing as well as the risk reward assessment into a trade. So on Monday, we make some money. So now we have that money booked in the bank for the week. That's how I like to think about it. So that's what I say here. Say we're up, say we're up, and if anybody wants this, I'll send it over. I'm not gonna leave it up here, but say we're up $100 on the week, okay? And maybe our normal position size is, or let's say we're up $50 on the week. And maybe our normal position size is, $500 or whatever. So we know that, our normal position size is $500 and we're looking for this same double bottom. We're going to use the same trade that we talked about earlier. Our normal position size is $500. We know we could buy, 3 of those contracts. Well, we know that our risk is $20 on each of these contracts. Well, we're only up $50 on the week. So what I do, I size down. I buy 2 contracts because I know my stop is $20 below me. I'm only up $50 on the week. If I get stopped out, I'm not going red on the week from this. So I'm only going to take those two contracts. If my stop hits, then I lose 40 bucks, but I'm still $10 green on the week. This is something that and we're just using random numbers. It doesn't matter. This is something that I try to teach all the time. Well, use it for your trading. Um, Maybe this trade hits and now you're up 100 bucks on the week. Well, maybe you decide that you want to take this bad trade up here. You got 80 bucks a risk or whatever, 50 bucks a risk, whatever it was on this contract up here, or 50 bucks down, I guess. You got 50 bucks down on this contract up here. Well, you're up $100 on the week. How much of your profit do you really want to risk on this trade? Not all of it. So based on your previous profits, you can really only buy one of those $250 contracts because if you stop, it's eating up half of your profits. So now you can say to yourself, do I really want to risk half of my profits on one trade for one contract? And maybe you don't. That's what I always try to teach people. Maybe you don't, but maybe you do. So you're up 100 bucks, you take this trade, you stop out, you stop out because it dumps against you. Well, now you're up $50 on the week. So now you say to yourself again, do I want to keep trading? And really for most people, the answer should be no. You're up, nice. You gave back some gains. Call it a day. Come back the next day, still got 50 bucks in the bank. Well, now for your next trade, you need to analyze that risk reward again. Maybe you're up 50 bucks. Maybe you're up 50 bucks or whatever it is. And you start looking for a trade, and maybe you want to, try a little short bounce here or a little short breakdown here, a little call bounce here. You need to analyze that risk reward. If you're, trying to short this and your stop's way up here, well, that's outside of the 50 bucks you have. So you cannot take this trade. Always, always, always manage based on your profits. You never want to you really never want to let a green trade go red. You also don't ever want to let a green day turn into a red day. And don't get me wrong, sometimes your first trade of the day is just all right, and your second trade will take you red. That's part of the game. But if you're nice and green, don't give back too much of that profit. Maybe you say, I'm up 1% on the day. I'm willing to give back 0.5% of that profit. Figure it out how you like to do it, but always, always, always consider how much money you have banked. So when you come down here and you see this trade and you say, okay, I got one risk and I got 3 reward, and maybe you're up 100 bucks right here. You got one risk and you got 3 reward. Well, maybe this is a trade where you say, hey, I am risking 50, 60 of my $100, but the potential reward is good enough that it's worth a try. So this is what I do in all of my trades every single day. There's even times, for anybody who's trading voice chat with me, I'll just buy one contract. If I want a foot in the door, if I have a trade that I, just kind of like, then I'll buy one contract. Then I can widen out the stop. I can let it work a little bit more. If it does get really beat up, it's not going to hurt me because I know I'm only playing with house money. So again, that's all this goes over. It just lays it out. If here's a Monday, here's a Tuesday, here's a Wednesday, maybe you take some wins, maybe you take some losses throughout it all. But all based on, charts, and everything is based on the charts, whether it's analyzing risk reward, and any entries, any exits, any stop outs, all of your position sizing, everything needs to be based on the chart. If you're always taking trades that pay you 10 bucks, you can't ever take trades that risk 30, $40 for you, because that will take you 3 or 4 trades to get it back. So does everybody get this? I know it's kind of a lot. Like I said, it was going to be a lot of talking tonight. I wanted to try to save us here 15 minutes at the end. Maybe we keep talking about risk reward and position sizing. Maybe we talk about charts, whatever it is. But I wanted to open it up with questions and make sure we had enough time for everything. Yeah, Mike finally quit running his yacht. Yeah, exactly, Raphael. 10% a day is just insane. And don't get me wrong, on a, if you have a $500 port, it's not, you can have days where you make 50 bucks and you make a 10% on your port day. If you find yourself having 10% port days, 30% port days all the time, you are either the luckiest person on the planet, or you are wildly over leveraged. If you have any sort of reasonable size port and you're putting up just those ridiculous gains every single day, then it's, there's probably something awry there. But I completely agree, and that's, that's always what I tell people. Find me something else that'll pay me 10 or 15% in 10 minutes and I'll do it. It's just there is only the stock market, that's it. Nice, Rudy, you got it. Yeah, JJ, and that's exactly what I'm trying to teach against here. Never revenge trade. Always, always keep those position sizes uniform. Keep them, higher risk, lower reward. You gotta size down. Any of those types of things. Sizing down is basically always the answer. It's even size down, take more trades. You can always end up at the same place. I'm sure all of you have heard me say it a million times. Give me 4 25% trades that I make those 25% in one candle, then give me 100% trade that I have to hold for 3 hours or whatever just to make it. Yeah, give me 4 20% trades all the time. That's what I'm looking for. Um, give me that over 100% that you have to hold all day, goes up 10%, goes down 20%, goes up 50%. I don't want that. Give me re-entries, give me that. That's of course just me, but always avoid the revenge trade. Do I use the 5 minute chart? So I do 5, 15, and hourly are what I always have pulled up on SPY and QQQ. I have a couple screens, but then all of my levels come from the daily time frame. So that's my way of watching the daily without having to watch the daily. Because all of my levels had reactions on daily time frames, then I know when we come to them, because I trust my levels. I maybe maybe yours are different, but I trust mine. Um, uh, that's my way to look at the daily time frame without having to look at the daily time frame. So this one was a direct message. Interesting question. If you believe in a trade and you are down, do you average down? So no, unless it was part of the plan. If averaging down was not part of the plan before you entered the trade, then you don't do it. You admit the fact your entry was bad. If you find yourself having to average down trades to make money, that means you need to work on your entries. And you're likely not respecting stops. And it's like I've said a million times, if your trade goes minus 60% and comes back to green, I'm super happy you made money and it was a bad trade. I will never vary on that. I mean, I don't know if you're in pro, your name is Zoom user. I don't know if you're in pro, but you'll see it on my spreadsheet. I'll say bad trade, bad entry. Maybe it worked, maybe it didn't, but I admit it. Like when I'm wrong in the market, you have to admit you're wrong. And we see it all the time. Somebody will hit SPY calls and they'll just start averaging them down as we keep going down. And, that is not a sustainable way to trade. However, maybe it's a day trade, maybe it's a swing trade, maybe it's part of your plan. I'm just going to use this randomly. Say you try to buy this double bottom, but if it doesn't work, you're comfortable adding to the trade down here. Well, now, before you ever buy this, your position size is cut in half. If you trade 500 bucks, you put 250 in, and then you add your whole position at the point where you planned on adding it. You don't like buy calls, start getting smoked, buy some more calls, start getting more smoked, buy some more calls, and sneak your way out in the green. That will work sometimes until it doesn't, and you get demolished, So if your plan does not involve an average down, you do not average down. Lambos, man. Gains tab dry since we turned into SPX addicts in OOT. Do level 2 data or time and sales data? Level 2 by a million times. No questions asked. Time and sales, one, most people don't read it, right? Let's pull up futures. This red right here does not mean sell. It means the market was going down when this order placed. That's all it means. Same as this. This green does not mean buy. It could mean buy, but it means the market was ticking up when the order was placed. So most people don't read time and sales correctly. The other thing, time and sales shows you orders that have already been filled, they're done, they've had their effect on the market. So they don't have a lot of information for us. Level two, on the other hand, lots of information. We can sell. See, we got 20 contracts at ES being sold at 47, 41, 75 right now. And unless this number on the left side starts getting bigger than this, we ain't getting past there because these are the orders waiting to be filled. So when you pull up, I mean, there's not going to be many exchanges right now. So when you pull up SPYs, you'll see some orders sitting at other levels, and maybe you're looking for a break over 570, but if you see a whole bunch of ask orders sitting on 570, there's a lot of people looking to sell there. So maybe you don't look for the break over it, but level two is 1,000 times more useful than time and sales. And then if you really want to, like, if you look at time and sales, say, oops, if you're looking at time and sales, say you see, 574125 people bidding. Well, we're seeing red over here. This is 574125 buy orders getting filled. The market's just pulling down into it to fill those orders. Not saying it's going to keep going down or anything like that. And then see, now we're seeing them pop up. That's because those the two fives on the bid side are getting filled as the candle is moving up. That's all we're seeing there. But if you don't match these orders to time and sales, you have no idea what's going on. Um, I do, I do think, I do think we're doing free VC tomorrow. I'm not sure. I think Flips is gone, so maybe Nando will be doing it. But if Flips is gone, then I normally do premium in the mornings on Friday, but I'll probably be in pro. But we'll see. Kermit, do I set my levels on the 4-hour hourly? Neither. Daily. They're always better levels. What's the best place to learn how to read level two? Watch it. That's the best. That's to watch it. It's a very hard thing to teach about because if it's not moving, you can't watch it. So this is gonna sound funny, and I know everybody knows that I love AT&T. Maybe you pick AT&T. Pick a slow moving name. Like AT&T, Coca-Cola, any of those names, and watch the level two on them. Know that the ask side is where people are trying to sell. So they're they're asking that price. Know that the bid side is where people are trying to buy. They're bidding to buy at that price. So watch something like AT&T, and you can watch AT&T go to a level, watch ask orders show up, and watch the market pull down. It's very hard to track on things like SPY, Nvidia, Tesla, any of those high volume, high volatility things, because it's moving so fast, it's hard to keep up with. So go watch it on some of those slower movers, and then shoot me a message if you ever have any questions. I'm not some great level two trader or anything like that. I do watch it I have it up most of the time. But uh, just go watch it on a slower moving name, and you'll start to see like, oh, this is how it works. It's very advanced while also being kind of simple. A lot of it comes down to how quick can your eyes work. How do you add level two? You click level two right over here on the right hand side of the screen. It'll be over there, and then it'll just pop it up under whatever chart you have pulled up. How do you have confidence reading the charts, candles? I've just watched a lot of charts and candles, honestly. Is the best thing you can do. And then learn price action. So how important are candles versus flow of the chart? Well, one can't exist without the others. The candles tell you what the market is trying to do. It's again another hard thing to learn because you gotta just watch. You just gotta sit and watch the market. Um, uh, you know, that's the best thing you can do. And so it's hard. You'll learn it eventually, but you just need to. I like to. So I'm seeing your second part of it. You couldn't pay me to trade a named candle. I've seen inverted hammers blow to the upside, shooting stars go the wrong direction, gravestone dojis do that, send us on rippers. I mean, named candles should not be traded. especially on shorter time frames. The guy who made them up, Hama, he's a genius. He rolls over in his grave every time somebody tries to talk about, named candles these days because they're used completely different than he made them up. They're for daily time frames, and people ignore what those candles tell you. Say you're shorting some sort, say you're shorting something because it's a reversal candle. Well, your stop is just the high of that candle. You need to know that's your risk. That's what the candle is telling you. What I tell people is you need to understand that candles are one of two kinds of candles. There's trending candles, big buys, closing near their highs, maybe wick on the bottom on a trending up candle is fine. Small wick on the top. You want to look for trending candles. Selling down, bearish candle, closing near its lows, small wicks. Those are the types of things you want to see for bearish trend candles. These are the types of things you want to see for bullish trend candles. Then you have range candles where maybe there are a bunch of inside candles. You got wicks on the top, you got wicks on the bottom. Oh, inverted hammer. Oh, normal hammer. You don't want to trade those name things. You want to trade what the candle is telling you. Who won on things, who lost on these candles. Start thinking of them as range candles or trend candles. You want bullish candles closing near their highs. Obviously, you can get a little worried on things like this, but bullish candles closing near their highs. And then you want to let the market say, okay, all of a sudden, here's a bearish candle. Here's a much more bearish candle. Maybe you keep holding because your stop's down here, or maybe you start to say, hey, there's a couple of bearish candles that maybe I want to exit this trade. So don't think of them as named. Think of them as what the candle is actually telling you. Because those named ones, man, they just so often don't work. And then to touch again, you were looking at it on the 15-minute. Look at it on the 30-minute, then look at it on the hourly. And all of a sudden, bearish 15 named candles can be bullish hourly named candles, but just trade what the candle is actually telling you. Kermit, levels on the weekly? Yeah, I mean, they're fine. They're great. They're great. Daily and weekly levels are great. Weeklies are good too, because you won't have very many. You look for those major things, same as you do for the daily levels. But if you're charting daily levels properly, you'll also be, because I chart all daily levels off major highs and lows, you will realize that you're getting those weekly candles and the weekly levels as well. Is there any videos or books that are good to watch? I don't have a good recommendation. Carmine, he's a big supply and demand guy. He has a couple good ones on reading level 2 and time and sales, but he's really moved on to, footprint charts and Bookmap and things like that. I wouldn't recommend it on NQ. No, yeah, they're great. It's great. But NQ is not for beginners. That is like some of the most advanced level 2 you can watch because that thing is flying. When you got 40 points per dollar on one QQ or per $1 on QQQ, the level 2 is on NQ is not a friendly place to learn about level 2. Whoa, Kermit, did you say that before I talked about Carmine? You did. Wow. Sorry, I'm playing catch up on these. Uh, but all of his stuff is good. I don't trade like him. He's just a good trader, but all of his volume stuff, all of his time and sales and level 2 stuff is really good. So in Thinkorswim, if you go up on your main screen, top left corner, you have to turn on real-time data instead of delayed data. And yeah, you can't have a 70-cent difference, that's for sure. Yep, JJ, gotcha. Yeah, Ben, no problem. So when will it be posted? So I'm gonna say tomorrow. We're having a little bit of shuffling for the people that are posting these lectures, and ideally I'm gonna start posting my own. So hopefully I'll be able to start getting them posted basically night of, but somebody also has to teach me how to do it. And so I think Toasty's gonna teach me tomorrow how to do it. So hopefully I'll be able to get this posted again, or get this posted real soon. Okay, so yes, exactly. Perfect little rundown. I was just going to give a little one. So yes, that's exactly what this was all about. Use the chart. If you don't want to get all the way into delta, you can of course use the SPY prices, 30 cents a risk, $1 move. You know, you got nice risk reward there. If you want to be more specific and know, you know, and like I said, so delta is affected by other Greeks, so it's always changing a little bit. So we might be able to say we're risking 18 bucks. Maybe it's 20 bucks, maybe it's 16 bucks, but we can get in that ballpark to really know how much we're risking. So always use the chart and say, is the risk reward worth it? How big should I size? Where is my entry? Where is my stop out? Where is my take profit? Once you have done all of those, you know risk, you know reward, you know, and in this order, entry, stop out, take profit. Entry and stop out are 1,000 times more important than taking profit. When profit comes, great. You need to know how much you're risking and live to fight another day. So identify your risk, identify your reward, identify entry, stop out, take profit, and decide if the trade is for you. And if you do that before every single trade, and this is all done before you click buy, if this is all done before the trades, you will, if you're struggling now, you will likely find yourself at the very least losing less money, but hopefully taking some much better reward trades. Okay, well, if that is going to do it, thank you so much, everybody. We had a nice little crowd tonight. I really appreciate y'all for being here. This was a fun lecture. Sorry, it was just a lot of talking, you know, but I think it's all very important stuff to learn if you want to be successful in trading. So thank you, everybody, for being here. And like I said, I think I'll be in pro tomorrow morning. I'm not sure, but you guys are awesome. I appreciate it. Nice crowd tonight. And uh, if you like these lectures, make sure you let MMA until you know you like them. Playing with you to go. Yep. Thank you, everybody. Thank you so much. And you know, as always, DM's always open. And thanks. We'll catch you all tomorrow. Have a great rest of your night.